Thank you. Excited to be here today. So just quick background. I run our alternative capital markets group globally for Goldman Sachs. And so our team's responsible for curating all of the alternative investments that we show to our family office and private wealth management clients globally. I'm excited to be here today to moderate a conversation with Mathieu Chabran, co-founder of Tikehau. Maybe Mathieu, for the audience, give a quick overview of your firm, and then we can talk about what we're seeing.
Well, first of all, thank you for hosting us. It's a great transatlantic leader forum once again, so thank you, Goldman, for having us. Tikehau is now what we would call a publicly traded alternative asset manager, managing roughly 40 billion. We're active across credit, private equity, real assets, capital market strategies. And listening to the previous panel, what I liked is that there's no difference between entrepreneurs, be for Loom or for Tikehau. We started with a mere, 400,000 euros, which is a lot of capital in itself, but managing 4 million euros of AUM. And I doubt, Kristin, that you're marketing that many 4 million euro fund at Goldman Sachs. So it all starts somewhere. And that's why it's great, for us at Tikehau to be associated, with the French founders, to this forum, because it's the same journey for everyone.
And today, 41 billion.
Today, 41 billion. We took the company public. Maybe we'll have the opportunity to discuss that. For us, it was not the exit. It was actually the beginning of the next chapter. And I think it all ties up with the discussion there's been having this morning about capital, liquidity, cost of capital.
So, from our seat, looking at the alternatives universe, there have been a couple of trends that we've seen. I would say last year, this year, we've been talking about the year of private credit, golden age of private credit. And then we've also been talking about kind of this need for liquidity in the market in the alternative space and a big focus on secondaries. Curious from your perspective, what have been the main trends that you've been seeing as an alternative asset manager?
Yeah, well, if we step back, 1 second, obviously what a difference a year makes, right, in terms of cost of liquidity, cost of capital. And I remember the discussion a year ago, maybe a bit more now, 16 months ago, recession or inflation. I'm not a macroeconomist, but there was a third dimension, which was the liquidity. And we just, listened, to this aspect that if I understood correctly, there's never been that much dry powder available, even for venture, which is not my focus. And I think this liquidity aspect is something that maybe after 10 years of very accommodating, policy, I think I once said that we were coming out of the mother of all happy hour, and that there will be a strong hangover. And maybe that's where we are, but there's still some booze available. The question is, what's the price, what's the value, and the liquidity aspect that you're mentioning. We're getting back to corporate finance 1.0, which is supply-demand. And the price of an asset, I'm not saying the value, but the price of an asset is where supply meets demand. On the way up, maybe valuation were disconnected to the price of the asset because there was a marginal liquidity that was relatively cheap, not to say free. And so it led to some situation where effectively you may have paid 100 for an asset when the theoretical value could have been 80. If the theoretical value of an asset is the present value of its future cash flow discounted at a risk-free rate plus a risk premium. So risk-free rate increased from 0 to 5. Risk premium increased from 100, 200 to 5, and all of a sudden you start with 10% cost of financing. So I think this liquidity aspect might be something that is creating a huge opportunity, for sure, because capital is here, but may have been maybe a little bit downplayed on the way up when it was way too available.
Well, so then maybe pivoting from that and thinking about a place where you had a lot of liquidity available and perhaps driving valuations higher than the intrinsic value, how do you think about growth equity investing? So, we talk about trends, and I talked about credit and secondaries. I would say go back 24 months, and growth was a very hot topic, and a lot of clients allocating to growth equity. How does your firm approach growth equity investing, and what do you see in the market today?
Yeah. So private equity is a relatively new strategy for us. We come from the credit world, where investment are somehow, contractual in the return and in the maturity. But what we have identified is that there's no shortage of great entrepreneurs, and, today is an illustration of that. But at times, the type of capital, they need for their venture, for their company has to be, fairly bespoke. Many entrepreneurs, have great idea, great solutions. They don't want to sell the company. The company tend to be, most of what we do, tend to be profitable. So I was listening to the runway discussion earlier on. I mean, we're in a different environment where investors, entrepreneurs have a solution and they need to scale. They need to scale and they're happy to give away 20, 30, 40% of their company. Sure, they're trying to maximize the price, but they're not selling. It's not an exit. It's finding the right partner, providing them the long-term, patient, flexible capital they need to weather situations such as the one we've been going through. And what we've seen and developed so far is taking a company with, 15, 20 million of EBITDA, be in Europe or here in the US, with a solution, and this capital that we can inject at relatively, more, I would say, conservative valuation. I know that, in the previous discussion and this morning, it's all about multiple of ARR, yeah. I'm still of the old world, with the multiple of EBITDA. And this, what we've invested is more like 10, 11 times. So again, back to valuation and price, it's where do you get in, with an entrepreneur for your investors, and if effectively the growth of the underlying business takes you from 20 to 60 of EBITDA, then for the exit, if you want to exit or if you want to scale the next phase, then it's a totally different discussion in terms of capital available.
And within your investing areas, thinking about some specific industries and themes, I know you mentioned cybersecurity as an area that your firm's focused on, thinking about impact and climate. Talk a little bit about kind of the themes that you're most focused on as a firm.
Yeah, so effectively, cyber defense, have been big theme. Decarbonization have been probably the main one that we took forward 6-7 years ago. I would say, before it became rightly so, really mainstream. Regenerative agriculture, and to give you an example of a company we just partially exited earlier this year, industrial, family-owned Italian company. Some of these companies, of northern Italy, with a real know-how, industrial, and they were doing rotors and stators for the automotive industry. So, very traditional industrial. And 6-7 years ago, they pivoted towards EV, but still, you need to make these pieces. We invested in September 20 of an EBITDA of 20 million. One of those very nice European mid-market, companies. 2 years later, so end of 22, we listed in March 23 on the Milan Stock Exchange, and they were making 90 million EBITDA. So a real growth, not of top line, of profitability. So, to tie that back, with the runway discussion, when you inject this capital, your investors, your LP, as a manager, they love this underlying valuation because it's based effectively not on a multiple expansion, but really underlying performance. And then you can find, a real exit with investors who now can take the company from 90, 100 to where it needs to be. We can reach 1 billion.
So obviously we're at a French founders event, French firm. Can you talk a little bit about how you think about investing globally? And in particular, kind of what are the differences you see between the US market right now, investing in France, investing in Europe, or more broadly?
Yeah. So I think that, so I've been here 5 years, so right before COVID, developing our operations for Tikehau. And then we had a bit of COVID, and then, a lot of COVID, and then we had a lot of repricing of the market, which started, as always, with interest rates. So I think it was around May 22 when, interest rates started to rise. And I remember that's the time of the year where, I then moved back to Paris. I work from Paris when school is over for the kids. And I was interacting with my colleagues and partners over there saying, something is happening. And they were like, no, everything is good. And I remember just having the first blips of some companies getting a bit tight on liquidity, people talking about runway. And I would say that to answer your question, Kristin, I wouldn't say that as always, but I think there was a quicker acknowledgement that the cost of liquidity was rising. It was rising steeply. I think now you know that. I mean, we've got the numbers. It never raised. I think the last time they raised that steeply was 30 years ago or something. And so I think that here in the US there was a much faster reaction to what was the new normal. And the question was, is it higher for longer? Was it just a blip? Does it control the inflation that they were trying to fight? And don't forget, I'm digressing 1 second, but for 10 years, and certainly post-COVID, the Fed action, the ECB action, and all the monetary policy, they were also the price setter of many asset prices. Obviously, they play with the base interest rates, but when the Fed or the ECB ended up being at times 30 or 40% of any given book of a bond issuance, any given company issued 100 billion euro bonds, I mean, the Fed or the ECB were 40% of the book. And so back to my point about supply-demand, here you've got the very visible end of the market. You know who is the price setter. And it was not artificial, but it was certainly not a natural supply-demand, balance. So here I had the impression that they reacted very quickly. As always, I think in the US, for better or worse, but remember SVB? Remember First Republic Bank? We flushed it down like in a weekend. That was 6 months ago.
Feels like years ago.
Yeah, no, but like in a way that if we rewind to Lehman Brothers and the GFC, if you look at European banks, for example, they've been dragging longer the cost and the burden of what was created on the back of the GFC in terms of regulation, etc. So that's the main observation I'm making, is maybe a faster to adapt to this new environment, and maybe also being more creative. Coming back to your question about liquidity, you can either look at the situation and saying it's stuck, or you look at the situation and you say, well, how can I create a liquidity solution to unplug, to unstuck the situation? And to your point, that's why secondaries in private equity were already hugely developed. Secondary in private credit now, we were debating backstage about secondary venture, tying back to what people were saying, and so that's what I see, where I see the main difference, and I think that's why we're very happy at Tikehau to be here, again to team up with French founders, and all the members, because we can be forward-looking and in the movement.
And when you look at Tikehau's investments, how much of it is in the U.S. versus Europe?
So it's still relatively modest. We went from 0 to 10%, so it's roughly $4 billion that we've deployed in the US over the past 4 years, I would say. Same thing, we raised also 10% of our AUM, which were until then exclusively Europe and Asia. And the opportunity, I mean, you introduce yourself, right? I mean, you're running this alternative pool for private clients at Goldman Sachs, and it's only going one direction. If history teaches us anything, it's the same way that institutional investors have increased their allocation to alternative. There is a high expectation that retail, high net worth, family offices, are doing the same, and it's a great way to direct also the capital, into the real economy, for sure.
Yeah, I mean, I guess I'd say from our seat, we see real resiliency in terms of individual clients investing in alternatives. Kind of over the past 5 years, it's been very resilient, very consistent. And as you allude to, one of the big trends that we're seeing in the alternatives industry is a pivot from an institutional client base and kind of looking forward to the next 20, 30 years of growth. Where is that going to come from in terms of investors being potentially more individual in nature? Along those lines, you've seen I guess a quote unquote democratization of alternatives and new products coming to market to address that semi-liquid. How is Tikehau thinking about that pivot or that evolution?
I mean, first of all, I think, again, money is fungible. So if you take any investor, private or institutional, he then look at his asset allocation and say, okay, risk-free, I can do 5%. If I do 7% for 10 years, if my math is still right, you will double your capital. If you do 10% for 7 years, you will double your capital. And so, and if you do 15% for 10 years, that will be a 4x. So coming back to the available opportunities, credit, secondary credit, even some real estate, where you have a contractual yield, coupon, and if you can get to this high single, low digit type of return, the investor will say, you know what, I've been suffering a lot of volatility, sorry. At times, I've been suffering a lot of losses. How many people have I met over the past few years? They all wanted to make a 10x, over the next year, because it seemed easy. All the asset classes that, by the way, we're not investing in, but they were like, sky was the limit. Now they're saying, why don't you give me 10% for the next 10 years? And so there's a reset in the expectation, which goes back to the cost of liquidity and return expectation. And that's a great news, because as they were saying on the previous panel, there's always been great entrepreneurs. Entrepreneurs starting in this environment, knows what it takes to give it a go. At times, to live very comfortable in a golden cage, to then convince some investors, and then that will certainly be, at the right, valuation. So I'm very optimistic, when I looked at the landscape. And back to your question, that's exactly what we're telling our investors, private, families, sometimes themselves entrepreneurs. They've been through the journey, they know what it takes, and they see, this cycle, once the dust settles, and we might be not too far from that, much more exciting, because you can do the work. You can work fundamentally on the assumptions you're making for your underwriting.
So that sounds like some optimism about where we are going forward in the cycle. I think we have a little over a minute and a half left here. What are the things that you're most concerned about, or what are the biggest risks as you think about being a global alternative investment manager, putting money to work over the next few years?
So I will not comment on the geopolitics, because that's an externality that we need to factor in, unfortunately, over the cycles. It might be, when we launched Tikehau in 2004, 20 years next year, I think 3 months Euribor was at 5.3%. 3 months Euribor today is at 4%, don't quote me on that, around that. And it was negative 0.5 9 months ago. So, just the cost of the seat at the table is already, 500 basis points, 5%, just to have a seat. No one has given you any money at that point. No debt, no equity. And so the main threat or risk, I think, in my view, is that people underestimate the fact that we could be in this environment for some times. I don't know if the next call of the Fed or ECB is to, I don't think the mandate is to reduce the cost of financing. Money, money has a cost, liquidity has some value, credit has some value, and that is, in my view, what should not be underestimated, because that's what impacts the whole asset spectrum, from venture to buyout to credit to real estate, you name it.
Great. So what else should we, and what have we not talked about in our last 20 seconds?
The opportunity, obviously, that you are, leading, at Goldman is a great illustration. When we started, again, 19 years ago, some investors in France, they were barely starting to look at corporate bonds. Post the GFC, they could look at some CAC 40 companies issuing at 8-9%, and they were like, how do I get access to that? Well, guess what? Today you can do low teens, mid-teens on a risk-adjusted basis, which is even more promising than where we were. And so the opportunity for retail, for investors, for entrepreneurs is clearly here. I think it's here to stay, at least for the foreseeable future, for sure. Yeah,
I think we agree with that. And as I said, we're trying to get our moderate clients to, close to a quarter of their portfolio in alternatives. And I think the next evolution is going to kind of more of the mass affluent universe and tapping into that and finding ways to put alternative investment products in structures that allow them to access it.
Yeah, and just, I was telling you to wrap up with one quote from certainly one of the leader for, or inspirational leader for all of us, Steve Schwarzman last week, which was reminding the audience that when he started Blackstone, only 1% of the capital of the institutional investors was allocated to alternative assets. Today it's 25, and they made a huge run thanks to that. I think, but correct me if I'm wrong, that's probably around the same level with private investors today, 1 or 2%. And so even if you take half of this journey, that's why I'm being very optimistic, because liquidity will be back.
Excellent. Well, thank you, Mathieu.
Thank you.
Very much appreciate the discussion.
Thank you.